The silver market just violated physics, not economics, physics. On January 2nd, 2026, the same metal traded at two prices so far apart that the gap itself became the story. New York says $73. Tokyo says $130. This isn't a glitch. This is a fracture. And what's leaking through that crack is the truth about how much metal actually exists versus how much the system promised. We're going to trace this break from Tokyo through Dubai through New York. We're going to watch the data form a pattern that normal supply and demand cannot explain. By the time we're done, you'll know exactly why this split exists, why it's accelerating, and what it means for anyone holding paper anything right now. The math stopped working. When math stops working in financial markets, someone is absorbing a hidden cost. We're about to find out who. Start with Tokyo. Mercari Japan, verified resale platform, completed transactions. 1-ounce silver coins selling for 19,911 yen at current exchange rates. That's $130. Not a listing, not a typo. Actual transactions. Metal changing hands at $130 per ounce. Same day, COMEX New York shows $73. Same metal, $57 difference. That's not a spread. That's a chasm. Tokyo isn't alone. Dubai physical silver, $115 per ounce. South Korea, $97. China, where exports are now restricted, $110. Everywhere east of London, the price is violently higher than what Western exchanges are printing. Now, come back to America. COMEX is here. The spot price is set here. You'd think metal would be available at spot. It's not. Go to APMEX right now. 100-ounce silver bars, wholesale product, industrial grade, no fancy minting. These normally trade at tiny premiums. Today, over $80. That's a $7 premium on a $73 spot price. 14% for a wholesale bar. The floor price in America, the price you actually pay to leave with metal, is already $80. Silver eagles and coins, premiums pushing 20% over spot. The $73 spot price is fiction. It's a number on a screen that doesn't reflect deliverable metal. We have 3 pricing tiers running simultaneously. Tier 1, COMEX paper at $73. Tier 2, U.S. physical reality at $80. Tier 3, Asian physical market at $97 to $130. The further east you go, the higher it climbs. This is the definition of a broken market. Every freshman economics student learns arbitrage. Silver is $73 in New York, $130 in Tokyo. Buy every ounce in New York, ship it to Tokyo, pocket $57. Arbitrage pressure should close that gap in days, but it's not closing. It's widening. When arbitrage fails, when the most basic mechanism of price discovery stops working, something is blocking the flow. And what's blocking it reveals the hidden architecture of the silver market and exposes a pressure point that could reshape the financial system. If you're finding value in this, hit the like button. This level of investigation takes time. Your engagement keeps this work funded. Now let's dig into why the gap exists. Simple answer. Metal can't move fast enough. But that's not the full story. First, logistics. Silver is heavy. Moving 10 tons from London to Shanghai requires armored transport, certified air freight, secure vaulting on both ends. Every secure logistics provider is maxed out. The planes certified to carry high-value bullion are booked through February. Armored trucks running 24-hour shifts. The pipeline is full. You physically cannot push more metal through fast enough to close the gap. Second, insurance. Red Sea tensions. South China Sea. Eastern Europe. War risk premiums for high-value cargo have exploded. Lloyd's of London is charging rates that eat arbitrage profits alive. Geopolitical chaos is acting as a tax on metal flows, isolating regional markets. Third, and this is critical, vault delays. Traders in London report that when they try to convert unallocated silver into allocated bars for shipping, banks that used to process requests in 48 hours now say 2 weeks. Why? Because in a fractional reserve vaulting system, the metal isn't always sitting there. It might be leased out. It might be in a sub-custodian vault in Switzerland. When you demand physical delivery to ship to China, the bank has to scramble to locate actual bars. This delay is a soft default. They're not saying no. They're saying wait. And while you wait, the opportunity closes. These 3 friction points create a speed limit on arbitrage. The gap persists for weeks because physical infrastructure can't equalize fast enough. This is why the divergence looks stable. But underneath, pressure is building. Here's what most people miss. If this were purely logistics, we'd see gradual convergence as shipping expanded. We're not seeing convergence. We're seeing divergence. The gap is widening. That means something else is at work. This is where it turns geopolitical. Beijing implemented a new export licensing system for strategic metals, including silver. According to regulatory filings, only 44 firms are now authorized to export silver from China. To qualify, firms must meet a minimum production threshold of 80 tons annually. In practice, small and medium-sized refiners, the ones that used to supply global excess capacity, are now banned from exporting. They can only sell domestically. This ring-fences approximately 60% of China's refined silver supply inside the country. It's a soft embargo. China hasn't announced a ban that would trigger diplomatic backlash. They've created a bureaucratic wall that makes it nearly impossible for metal to leave. Shanghai inventories rising. London inventories falling. China is accumulating silver without declaring a strategic reserve. They're doing it quietly through administrative policy, not open market purchases. Resource nationalism disguised as regulation. Now look at what this creates. China is the world's largest manufacturer of solar panels, batteries, electronics. All of these require silver. By locking down domestic supply, China ensures its industries have access at stable prices, while the rest of the world competes for shrinking supply at rising prices. Economic warfare through resource control. Here's the kicker. Because COMEX spot is still $73, every ounce of silver leaving the United States is being sold to China at a massive discount. Paper price suppression in New York is subsidizing Chinese industrial expansion. The West is hemorrhaging strategic resources at 50% below global market value. This brings us to the core question. If the real price is $130 in Tokyo, why is the paper price still $73 in New York? Why don't the banks just let it rise to reflect reality? The answer is insolvency risk. When a mining company hedges future production, the bank takes the other side. The bank goes short. Normally fine. They hedge it. But somewhere along the way, the banks got greedy. They sold more paper contracts than physical metal existed to back them. They went naked short. They've promised to deliver silver they don't have and didn't borrow. According to data from the Office of the Comptroller of the Currency, the notional value of precious metals derivatives held by U.S. banks runs into the billions. When silver was $20, this liability was manageable. At $73, it's painful. At $130, it's catastrophic. If the major bullion banks are net short 500 million ounces and the price rises $60, that's a $30 billion loss. That's not quarterly earnings. That hits Tier 1 capital. The emergency reserves regulators require to prevent collapse. If Tier 1 capital drops below regulatory minimums, regulators can seize the bank. It's over. The traders at these institutions aren't suppressing price to profit. They're suppressing price to survive. They have a pain threshold. We don't know the exact number, but market behavior suggests somewhere between $80 and $90. Every time silver approaches $80, massive sell orders appear. That's not profit taking. That's a defense line. They're suppressing price because they cannot allow delivery. But they can't hold positions indefinitely because physical metal is draining from Western vaults. The only option is to keep selling paper contracts to suppress price, which makes the short position bigger. They're digging the hole deeper to keep the walls from collapsing. This creates a classic death spiral. By keeping paper at $73 while physical is $130, the banks are incentivizing the entire world to drain Western vaults. Smart buyers purchase COMEX contracts at $73, stand for delivery, take the metal, ship it to Asia where it's worth $130. The suppression strategy is accelerating the very default it's trying to prevent. We're watching Gresham's law in real time. Bad money, overvalued paper contracts, is driving out good money, undervalued physical silver. Registered inventory at COMEX has dropped approximately 70% since 2020. When it hits zero, the paper price becomes irrelevant. You can print a contract saying silver is $70, but if there's no silver to deliver, the contract is worthless. The market moves to the real price, and the real price is what they're paying in Tokyo. Let me give you a sense of what this pressure looks like from the inside. Imagine you're a risk manager at a major bank. You wake up every morning and check two numbers. 1. How much silver is left in COMEX registered vaults? 2. How many delivery requests came in overnight? Every day, those numbers move in the wrong direction. You know the math. You know there's a day, maybe 6 months from now, maybe 6 weeks, when the vault empties and you can't deliver. On that day, everything breaks. So what do? You hope industrial demand softens. You hope investment demand fades. You hope something changes before the vault hits zero. But nothing is changing. Demand is accelerating. The gap is widening. The banks can't escape without destroying themselves. And every day they stay trapped, the wealth transfer accelerates. Physical silver flowing out of the West into the East. The West gets dollars. You're thinking, if this is real, if the system is this fragile, why hasn't it collapsed already? Why is price still holding at $73? The answer is the system is designed to fail slowly, not suddenly. The mechanics of default and derivatives markets are complex. Banks don't wake up one morning and declare bankruptcy. First, they negotiate. They delay. They invoke force majeure clauses. They lobby regulators for emergency rule changes. The goal is to manage the collapse, not prevent it. Here's what the endgame likely looks like. Physical vaults run critically low. Delivery requests spike. Price starts surging toward $100. At that point, the exchange steps in. They halt trading. They declare a settlement emergency. They force all contract holders to cash settle at a fixed price, maybe $80, maybe $90. You get a check. You don't get metal. This saves the banks from insolvency, but vaporizes the wealth of everyone holding paper contracts. Meanwhile, the physical price in the street market goes to $150, $200, maybe higher. This is why people scream, if you don't hold it, you don't own it. If you're holding an allocated silver in a bank account or futures contracts on COMEX, you're not holding metal. You're holding a promise. And when systems are under stress, promises get broken. Let me make this personal. If you're watching this, you're probably paying attention to metals markets. Maybe you've been stacking physical, maybe watching miners, maybe just trying to understand why everything feels unstable. Here's what you need to understand. The $73 price on your screen is not the market. It's a snapshot of a market in the process of breaking. The real market, where actual metal changes hands, is trading at $80 in America and $130 in Asia. This is not conspiracy theory. This is observable reality. You can verify every price I've mentioned. Go to APMEX. Check the premiums. Go to Mercari Japan. Check the yen prices. The data is public. The fracture is real. The only question is what you do with that information. If you found this valuable, subscribe. We're tracking this story as it develops. Vault inventories, premium spreads, the mechanics of this unfolding squeeze. You don't want to miss what happens next. Now let's talk positioning. If you understand the paper price is artificially suppressed and the real price is significantly higher, how do you position for the eventual convergence? 3 options. Option 1. Physical metal. You buy coins or bars. You take delivery. You store them securely. You're out of the banking system, out of the paper market. You own atoms, not promises. Downside is liquidity. If you need to sell quickly, you'll face bid-ask spreads and delays finding buyers. Option 2. Allocated storage. You buy physical and store it in a professional vault with segregated allocated holdings. Your bars have serial numbers. Your name is on them. Security of physical ownership with better liquidity than home storage. Risk is counterparty risk. You're trusting the vault. Use reputable services with full insurance and third-party audits. Option 3. Mining equities. This is the leveraged play. Silver mining stocks are still priced as if silver is $30, not $130. Why? Wall Street algorithms value miners based on COMEX spot price. When quarterly earnings report record cash flows from selling metal at real-world prices, algorithms will reprice the entire sector. This creates torque. If silver doubles, mining profits don't double. They triple or quadruple because of operating leverage. Risk is equity market risk. Stocks are volatile. Management matters. Jurisdiction matters. But for sophisticated investors who understand the sector, mining stocks offer highest potential return. Here's what you should not do. Do not hold unallocated silver in a bank account. Do not hold paper ETFs that don't allow redemption in physical metal. Do not hold futures contracts unless you fully understand settlement mechanics and have a delivery plan. When the snap happens, when New York gaps higher to catch Tokyo, unallocated holders will be cash settled at the old price while physical rockets. You'll get dollars. You won't get metal. And with those dollars, you won't be able to buy silver because price will have already moved. Let me address the psychological component because this is where most people fail. Seeing silver at $73 and knowing the real price is $130 creates cognitive dissonance. Your brain says the screen price must be real because it's official. It's on Bloomberg. It's on CNBC. But the screen price is not real. It's a derivative of a promise. The real price is what someone pays for metal they can touch. When silver crosses $100, it changes global psychology. At $73, people think silver is expensive. At $100, they'll think it's valuable. That sounds contradictory, but it's human nature. When an asset crosses a major psychological threshold, it validates the entire thesis. At $100, silver enters the conversation alongside gold and Bitcoin as a Tier 1 reserve asset. That triggers FOMO. Pension funds chase. Tech companies hoard. Sovereign nations panic. The move from $100 to $200 happens faster than $50 to $100 because at $100, the secret is out. You need to be mentally prepared for this. Be ready to hold through volatility. Do not sell your first ounce at $100 just because it's a round number. $100 is just the inflation-adjusted equivalent of the 1980 high. It's the starting line of the real bull market, not the finish line. Here's the final piece. Why is this happening now? Why is the fracture widening in January 2026 and not 5 years ago? The system has reached a breaking point. For decades, the paper market could control the physical market because Western vaults had enough inventory to meet delivery requests. But 3 things changed. First, industrial demand exploded. Electric vehicles, solar panels, electronics consuming silver faster than mines can produce. Second, investment demand surged. After years of monetary instability, individuals and institutions are moving into hard assets. Third, Eastern nations started accumulating. China, India, Middle Eastern sovereign wealth funds buying physical metal and removing it from Western markets. The combination of rising demand and falling supply has drained Western vaults to critical levels. The paper market still has the illusion of control because they can print infinite contracts, but the physical market is running out of inventory. When the last bar leaves the vault, the illusion shatters. The paper price becomes irrelevant. The physical price becomes the only price that matters. Here's what makes this moment unique. We're watching this in slow motion. The data is public. Vault inventories are published. Premiums are visible. This isn't a surprise event like 2008 where everything collapsed overnight and nobody saw it coming. This is a slow motion train wreck where you can see the collision from miles away. That gives you time to position on the right side. Here's the verdict. The United States is losing control of the silver market. For 50 years, Western banks controlled price through paper derivatives, but they forgot to control the physical metal. Now the metal is gone. It's in China. It's in India. It's in the Middle East. The price discrepancy we see today, $73 versus $130, is the death rattle of the paper suppression scheme. It cannot be sustained. Arbitrage is a force of nature. Eventually, physics wins. Prices converge. In this case, convergence means New York rises to meet Tokyo, not the other way around. The fractured market is not a problem. It's an opportunity. It's a window where you can still acquire a strategic asset at a discount before the rest of the world realizes what's happening. The people buying silver in Tokyo at $130 aren't stupid. They're seeing something the West refuses to acknowledge. They're seeing the end of the dollar's dominance. They're seeing the revaluation of hard assets. They're seeing the future. You have a choice. Watch this unfold from the sidelines or position yourself now while the paper price still offers a discount. The data is clear. The fracture is real. The convergence is inevitable. What you do with that information is up to you. If this investigation gave you clarity, subscribe. Drop a comment telling us what you think happens next. Force majeure settlement, violent snap up, or does the system kick the can further down the road? I want to hear your perspective. This is not financial advice. I'm not telling you to buy or sell anything. I'm showing you the data and letting you make your own decisions. But I will say this, we are living through a historic moment. The global monetary system is restructuring. Hard assets are repricing. The people who understand what's happening have a once-in-a-generation opportunity to position correctly. The $130 price in Tokyo isn't an anomaly. It's a forecast.